Welcome to YCC Capital Macro Research. We don't follow headlines, we follow the data. Every day, we analyze the world's largest economies, financial markets, and geopolitical developments to uncover the structural forces shaping tomorrow's investment landscape. Let's begin. One of the market's most important signals is quietly flashing a warning. Long-term U.S. Treasury yields have moved decisively higher, climbing back toward the upper end of their recent range rather than falling into a traditional safe haven pattern that many investors would expect during a geopolitical crisis. At first glance, renewed military tensions between the United States and Iran should have pushed investors aggressively into treasuries, driving yields lower. Instead, the opposite has occurred. That divergence tells us the bond market is focusing less on immediate fear and more on the inflationary and fiscal consequences that could emerge if the conflict escalates. The most obvious transmission channel is energy. Any threat to shipping through the Strait of Hormuz immediately raises the probability of higher global oil prices. Even without a complete disruption, markets begin pricing a geopolitical risk premium into crude. Higher energy costs eventually filter through transportation, manufacturing, logistics, and consumer prices. In other words, geopolitical instability can quickly become inflation instability. That matters because inflation expectations are one of the most important drivers of long term treasury yields. Investors demand greater compensation for holding fixed income securities when they believe future purchasing power will be eroded. The result is higher nominal yields, even as geopolitical uncertainty increases. There is also a second force at work. A prolonged Middle East conflict would likely require higher U.S. defense spending while simultaneously making the Federal Reserve's inflation challenge more complicated. Fiscal deficits could widen further, just as the Treasury continues issuing large volumes of government debt. Greater supply, combined with weaker demand, naturally pushes borrowing costs higher. Think of it as more bonds chasing a market that is becoming increasingly selective about the price it is willing to pay. This creates an unusual macro environment where treasuries lose some of their traditional safe haven characteristics. Instead of acting purely as a refuge from geopolitical risk, they increasingly reflect concerns about persistent inflation, expanding government borrowing, and structurally higher interest rates. Equity investors should pay close attention. Higher treasury yields raise the discount rate applied to future corporate earnings, putting pressure on richly valued growth stocks. At the same time, tighter financial conditions increase borrowing costs across the economy, slowing investment and making refinancing more expensive for both companies and households. The broader message is that markets are beginning to treat geopolitical shocks differently than they did over the past decade. Rather than assuming every crisis leads to lower rates and more monetary accommodation, investors are recognizing that today's conflicts can reinforce inflationary pressures and fiscal expansion simultaneously. That changes the entire investment playbook. As long as tensions between the United States and Iran remain elevated and energy markets continue to price geopolitical risk, upward pressure on long term treasury yields is likely to persist. Investors should therefore monitor not only the headlines from the Middle East, but also the bond market's reaction, because it may provide the clearest indication of whether this conflict is evolving from a regional security event into a global macroeconomic challenge